in a nutshell, give us your hypothesis.
I think the focus on who's paying for the U.S. tariffs is really out of line because the U.S. strategy is to try to shift global supply chains. We all know that the overall balance of payments is set by macro policies, but trade policy is able to switch where the surpluses are and where the deficits are. And what the U.S. is trying to do is to say, we're going to take some of that deficit away from China and divide it among some of our friends using bilateral trade agreements. And so the tariff is just one of the tools in the toolkit of this strategy of trying to reshift the supply chains globally to, one, increase domestic production, but also domestic production for our friends.
But it sounds too well thought out.
Well, I must admit, it's something that I feel is the only thing that could, where I can understand why the U.S. is using trade policy the way it's using it. Because Donald Trump came in and said, I'm going to make America great again. How? I'm going to try to restore as much manufacturing, but not just any manufacturing. He wants high-wage manufacturing. So by shifting supply chains so that we shift the pattern of tariffs and pattern of surpluses, what the U.S. is able to do is to say, we're going to try to promote productivity and investment here, which is part of the tax cut. And the productivity is going to give us the high-wage jobs.
Chang Shu, are we seeing any evidence of this then actually happening already? We've already seen some people moving to Vietnam, but some industries, perhaps in the high-tech side of things, and others are not suitable.
So the sort of the shifting production out of China, that started even before.
Exactly. So it's something which already happened, but does it actually necessarily go and get molded to the way America wants it to be? That's the thing.
Yeah, that's certainly the question. So there has been some shifting of production out of China, and that includes both by Chinese firms and foreign firms. There are a lot of anecdotal stories. Chinese factories are trying to set up branches in Vietnam, in Malaysia, etc. So it's not very clear whether it's going that way.
The reason why it's not clear yet is because the trade of the 21st century and production of the 21st century is in scale economies. China's strategy has always been, we're going to be standard setters in the new technologies, and they're going to select those new technologies, 5G and all that. But the U.S. also wants to be standard setters. So in order for economies to really do well, they have to have the scale. And so essentially the U.S. and China are setting up a framework to divide the world. It's another Yalta. We're trying to divide the economic world in a way to let the U.S. and China both gain.
That's why I've been calling it a trade war with technology characteristics. Anyway, so, but what is there any evidence of all this in the latest trade data and the trade data we had before, of course?
Yeah, as Tom was talking about earlier, certainly our interpretation is it's not quite in the data yet. For May, export data really surprised on the upside, even managed some sort of expansion. But going forward, the picture is not so positive. If you look at the leading indicators in terms of China's major trading partners, U.S. and Europe and Japan, all showing some slowing down. U.S. The market PMI saw the biggest decline since 2016.
But it's the manufacturing sectors that are getting hit, whereas China's domestic retail sales have sustained themselves. And the key is whether fiscal policy is able to boost domestic demand, because the health of the global economy depends on China right now. And Germany depends on China. Europe depends on China. So the U.S. in some ways also depends on China. And the key is to make China grow fast. And whether they'll do it with fiscal policy or not is a real open question.